Good morning and welcome to Bazaar Morning Call. I'm Anuj, with me, Prashant and Sonia. As always, it's the weekend of course, what's been a truncated but a volatile week. And the big headlines this morning are coming from the money markets, not from the equity markets. Whether equity is getting impacted or not, we'll find out. For me, the big headline is the US bond yields trading above the risk of threshold. If you look at 2-year, 10-year, 30-year. In fact, I was reading a Bloomberg article this morning that for the first time in a generation, the global bond market is in a bear market. I mean, equities go in bear markets many times, but for bond markets to go into a bear market is telling you the kind of times we live in. The dollar index very close to its 20-year highs, 110. It retreats from there, so that's a bit of a help. But equities have been resilient overnight, US as well, and emerging markets in particular have been quite resilient. So let's see if it can be taken in its stride. The SGX Nifty, for starters, is flat. Hi guys, good morning.
Hi, good morning,
Anuj.
Anuj. Morning, Prashant. It's a bit volatile, right, the SGX Nifty, so perhaps that could be the order of the day as well. But as you rightly pointed out, all eyes will be westwards to get to know what's happening across the globe. The US markets were not too bad, actually. The Dow was up about 150 points overnight. All eyes will be on the US jobs data that comes out later today, and this is the last piece of macro data before the September Fed meeting, remember? So it's going to be important to track. The estimate is that 318,000 jobs would be added. This compares to, of course, that phenomenal 528,000 jobs number that we saw in July. So let's see what comes through. But remember, since the last Jerome Powell speech, the US markets are down 7%. So there's definitely some trepidation as we head into the September Fed meeting as well. The US markets, in fact, will be down for the third straight week by the end of today. And the dollar index, I mean, something that we've been tracking, ad nauseum, is now what, at a 20-year high, almost hitting that 110 mark. So that's something that emerging markets should brace themselves for as well. For our own markets, it's been very resilient. Yesterday, there was a large sell amount of almost 2,300 crores, though. But this 20-day moving average of 17,580 or so is something that the market is testing. Let's see, does that get taken out? It's held for now. But, that's the big question, Anuj. The market has been resilient this far. But given that there is a September Fed meeting, given that, there's the US jobs data later tonight, do you reckon that the second half of trade could either bring volatility or a bit of a sell-off? Yeah,
volatility is fine in the market. It should, it has to go through these phases. But Sonia, I mean, if 10 days back you were asked that post-Jackson Hole, the US market would be down this much, right? 7% or so. And the Nifty would be at 17,500. Would bulls have taken it with both hands? So I think that is clearly the outperformance. But yesterday's key highlight for me was not just FI selling in cash market, but the FI selling in the FNO market. In particular, in futures market, where FIs have gone all in. I mean, there was unwinding of 6,000 longs, but addition of 40,000 shorts. Now, in some senses, it's good for markets to have shorts, because if there is a rally, then shorts actually provide the best sort of fodder for that rally. In fact, the FI long exposure is now down to just about 27% right now. So if yesterday's low is protected, in that case, there can be big short covering. In any case, the Nifty defended the 20-day exponential moving average. In volatile market, you tend to give more importance to the exponential moving average. That is at 17,425 thereabout. So what I'm going to give you today is a bit of a range. Yesterday's low and high, 17,450 to 17,700. I mean, if you're a smart trader, it is easier said than done, right? But going by the price action, if you're a smart trader, your trades are to sort of try to buy as close to 17,450 and try to sell as close to 17,700 with about a 40-50 point kind of stop. That trade has worked in the market, and it's difficult to take when the market's moving in that direction, to take the opposite direction straight. But that is what's working in this market. Selling the big rallies and buying the big plunges is something which is working. This range, if it breaks, then you'll have an expansion. And in an expansion market, then you take it differently. But till then, it's a bit of a contracting market within this range. The big risk to this market still is what's happening in the money market, as I said, the dollar. Because if that has to go past 110, maybe 112, 113, does that impact the recent FI inflows? Was that a bit of a hot money which was chasing our market? Because in the near term, it's all about momentum. And if momentum breaks, then things can get really dire. So that's why I'll keep an eye on dollar index and the FI flows. This is not a market in which you want to take a linear one-way view. Really, the market is changing so fast, and as a trader, you'll have to change yourselves. Or of course, you can be an investor and pick at your good quality stocks in the mid cap market, which is doing extremely well. But Prashant, hi, what do you have for us?
I mean, flat close, right? It looked like it's going to be another dark, deep red on the screen when we come back, but not to be. So the market bounced quite significantly, nearly reversing all the losses overnight. I mean, at one point, the S&P was down almost, NASDAQ was down 2, S&P was down 1.5, but look at these closes, so absolutely fine. The S&P in the very near term has got a horizontal support at between 3900 to 3919. Yesterday's low was 3909. So the market got to these levels and then bounced. So let's see if this holds. I would say, eventually this breaks. Just the way things are set up and the market heads lower. I'm talking about the S&P right now. The big positive, so rates were, the 10-year was up 6 basis points. The 2-year in the US is about 3.5% odd. But okay, that's fine. I mean, it's been happening for a while. Oil sold off another 4.5% odd, and that's a big one for India. It's at $93. So I'm making this point yesterday that oil went up $10 when after the Saudi Arabia energy minister said that they need to cut output to balance the market, and then it climbed down $10 as soon as markets realized that, well, maybe it's not coming. In any case, the OPEC Plus meeting on the back of which this $20 move on oil happened is on Monday. So we will find out. There are some who believe that there is a big difference between paper markets, financial markets, which is what you see on your screen, and what you're able to buy crude at in the market out there. So there is scarcity. And prices need to reflect that eventually. It's not great news. I mean, if that pans out for a big importer like India. But for now, we're at 93, and that is what matters. Okay. Here in India, the Nifty closed below its 20-day moving average at 17,589. Anuj made this point earlier. Just to reiterate, FIIs are short in index futures now by some 60,000 contracts. So this is, and I've said this before, short positions in index futures are a comfort, but you need to see where you are at. In the lows in June, FIIs were short in index futures by some 140,000 contracts. Are we at the beginning where shorts will keep getting added all the way to that very large number, lakh plus, lakh 20 plus? Or, I mean, this is it. From here, the market kind of bounces. So, where we are in that process would make all the difference. But in any case, FIs, irrespective of what they've been doing in the cash market, are now short 60,000 contracts in index futures. Up ahead, in terms of very near-term cues, you've got the jobs data for the month of August, which I think is important. Monday is a US market holiday. And then we got CPI numbers, consumer price inflation numbers, on the 13th of September, today's data and then the inflation number, the CPI number, the 13th, all of it will culminate in the Fed meeting, which is a little later in the month of September. So important data points, etc., which are stacked up. Just one more thing I want to leave with. Today is the 2nd of September. As we all know, from the 1st of from September onwards, the pace of quantitative tightening in the US is picking up. It's doubling. It was, I think, about just under $50 billion. It doubles to almost $100 billion of QT a month. What that does is it leaves lesser dollars in the system, and it pushes up the dollar. That's not great news for emerging markets. Let's see if it pans out that way. We'll try and put out more data on this in terms of what has happened in previous episodes when there has been QT. There was QT in 2018. There was QT in 2012. We'll see what was the experience back then. But this is unprecedented. The pace of it is unprecedented. $100 billion being taken out of the system every month starting September. Sonia.
Okay, I think that's a very important point Prashant made. 2 weeks back, I was highlighting this short position in the US market, the record short position in S&P 500 ahead of Jackson Hole. The $107 billion of shorts that hedge funds were sitting on S&P 500. And the big question was, what do these shorts know? And while having shorts in the system is always comfortable, you don't know, if they cover or they carry on. And, if they carry on, do they have something at the back of their mind? For example, in the US market, the shorts, I think, are still in the system, and they're sitting on decent gains. And even then, they're still in the system. So are they expecting the US markets to go and revisit the June lows? I think our market is still some distance away. But in the US market, there's an eerie feeling that, perhaps June lows could happen in the month of, maybe October itself. That is, going by the chartical readings of how the markets have shaped up. So that way, it will be important to track the short positions from here on.
Okay, well, lots to track today. For now, the SGX Nifty is indicating that the start will be absolutely quiet. But let's see, we've been holding on to the 20-day moving average, and it has been a very resilient week for our own markets as well. On the equities front, we have Vikas Jain of CLSA, who says a near 20% rally in Indian equity markets from June lows was despite earnings cuts and possibly due to a cool-off in the bond yields driving up valuations. He says given rising Fed hawkishness, they skimmed the top 90 global markets to look at equity and local bond valuation comparisons. He says the US and India are the only markets where bonds have become more attractive than equities, and India's relative valuation to peers is also above the 98th percentile, and such valuations have historically yielded negative returns. He recommends a caution on stocks with multiples at big premiums to history.
Okay, that's a very important call actually, and I remember the last time this happened, the money market funds actually did better. This is the point that Nair also made about perhaps getting into some kind of money market funds. Let's get you some money market views then. Bhaskar Panda of HDFC Bank says that the US initial jobless claims are better than expected. He says that expectations of a 75 basis point rate hike in September's FOMC is higher at 75%. He adds US yields are higher, oil prices are down, dollar index remains above 109.5. Given this global backdrop and with Asia ex Japan in green in the morning, he expects the USD INR pair to trade in a range of 79.55 to 79.75 for the day. Keep in mind, today is also the weekly options expiry on the currency side.
All right, and on the bond side, Bhaskar Panda says that the Indian bond yields have come down primarily due to lower oil prices and the downside looks limited. He expects the 10-year benchmark bond yield to trade in a range of 7.2 to 7.25% for the day. There are plenty of stocks that we're going to track in just moments from now, so we'll get to that in a bit in our top 10 segment. We're looking at Eicher Motors, NTPC, Aurobindo Pharma, Dodla Dairy, Confidence Petroleum, Ramco Systems that are on the back of positive news flow, and Hero MotoCorp, ONGC, Oil India and Hinduja Global that are likely perhaps to open in the red.